Hi, everyone. I'm Amanda Fisher. I'm Policy Director and COO of Better Markets. And I am so pleased to be able to introduce Tom Ferguson, a member of our Academic Advisory Board, to give some remarks on his research on crypto and its political economy, a topic that really could not be more timely given everything happening in Washington, D.C. Briefly, to introduce Tom, he is the research director at the Institute for New Economic Thinking and a professor emeritus at UMass Boston, as well as a senior fellow at the Roosevelt Institute. Tom has his PhD from Princeton. He previously taught at MIT and the University of Texas, Austin, and is the author of several books, including Golden Rule and Right Turn. In addition to publishing in the top academic journals, Tom's writing also reaches the public in outlets such as The Nation, and really a foremost scholar on the influence of money in politics and how that is a flywheel for inequality. So, Tom, we are so pleased to have you.
Look, I'm going to just stand and thank you, Amanda, for that. And first thing I have to say is it's actually so pleasant here. I'm kind of suffering from a reverse post-traumatic stress syndrome. It's like last night, everybody I met, many for the first time, I liked. I listened to the discussions. I agreed with them. And, this morning, who's going to cavil about that? No. I can't really emotionally deal with this, and it is something of a problem. And I know it's affecting my thinking. And so did Dennis a bit this morning when he said, I got to find a happy ending. And I thought, Dennis, no. If you want a happy ending, see a Disney movie. That's been my slogan for many years. And then that sort of went bad when Tim Burton joined them. And I actually think sometime for imagery, we might want to have a little session on good financial disaster imagery. But what I want to talk about today is the banks versus stable coins. I got a nice chuckle from what was on there, which is crypto's political enemy. I think that was supposed to be political economy, but I admit I'm not a fan of crypto. And I'm not a fan of the ordinary banks either. And that's something of a problem here. In that, how do we know? There it is. Yes. I've been warned, don't overdo this because you can't go back. So what I want to just talk about, I just forget all the legal stuff. Is it a security? Is it something else? It's not super currency. And just talk about some preliminary results I have been running with some of my colleagues, Ji-Chen, Paul Jorgensen, Matthias Lalise. And the question is this. We're trying to understand, the big question in the background is, hey, how did this miracle happen? FTX took down zillions of people, cost them a lot of money, etc. Somehow this thing, crypto, comes back in like just a couple of years. It is amazing. It's like home mortgages, in 2006, having 2008, and then coming back in 2010. The one point you made was, hey, it took 15 or so years to get the economy back, right? To sort of where it was for what happened here. This is not a problem. Now, the problem here for statistics is, in the Republicans, there's no variation. Everybody's getting cash. And further, you're in a hierarchical structure where the president, red tech, as I'm sort of calling this intersection of technology, finance, and actually defense, and they're all move easily between these things. That's another discussion entirely. And the new administration is simply full of people. There's just not anything to discuss on the Republican side. But look, what's going on with the Democrats, right? The votes last year were not just, genius versus clarity, but they were somewhat. And the best the House Democrats mustered last year was 42, with the administration saying no. This year, they got 102 votes. 102 Democrats voted for the Genius Act, which in this audience, I think you know what that is. And the 78 voted in favor of clarity. The Senate shows somewhat similar patterns here, but there are many fewer cases for the Senate. We're doing the Senate too, but hey, you're talking 30, 40 cases, whereas you got lots and lots of statistics in there. So I'm going to forget all the sort of details. What didn't explain, so what we did is we looked at, okay, you get a data set of all the Democrats. A couple of folks sat out both votes. I'm wondering what those folks, could we do an equation on those? Maybe, but not. Anyway, they get dropped. But what doesn't explain Democratic voting? Well, the Trump-Harris difference didn't matter. The margin of victory, which is a sort of perennial of orthodox political science, and which in fact generally doesn't explain much, or the most ethnic or racial age of the legislators, because there were people thinking, well, maybe the really with it people are younger, and that. I mean, look, this I've seen. I'm almost quoting stuff I've seen in papers. Right at the very top and going down, or state fixed effects, which is never mind that. You just don't probably want to know, and it just doesn't matter that there's some unique disaster in a state or something about the political culture that persists for and there are no spatial hangovers. You can run a spatial regression. What did matter? Okay, percentage of households making $200,000 or more. That was a plus. Two popular indices of legislators' ideology. This, too, is more technical than we need. It's the Nelken pool, which is, if you're curious, that one is a little different from the usual denominate scores that you see around in a lot of places, because this one uses only the placement of votes in the session, not across time, because across time stuff, I'm convinced, is pretty much garbage. But that's neither here nor there now. And the basic meaning, you're going to be amazed to discover that more conservative Dems voted for crypto. Then, of course, the favorite, I knew it was going to happen, and it's the total amount of money. Now, look, I'm just going to stipulate, I like Open Secrets for what it tries to do. You cannot rely on their totals. Academic studies like Meehan and Sufi that use that stuff, they're way off. And in the case of Meehan and Sufi's famous article in the American Economic Review, my colleagues and I found that it was off by 50%. A result, by the way, that I warned about before the American Economic Review accepted that. But so we roll our own, and we've been doing AI-assisted stuff for the last 2 or 3 years. But then we come to the variable that we didn't anticipate, percent Hispanic. Like, I went, what's that? And, well, let's set that to one side. And I just want to ask, is there anything, you've heard results like this before? Yeah, in the bad old days before 2008, though the academic work on pre-2008 is actually leaves a lot to be desired. But the one I like, I would say that even if I hadn't co-authored it, is the one about how the watering down of Dodd-Frank proceeded, where what we did there, it was, we looked at floor bills in the years following the passage of the Dodd-Frank reform bill. And this thing focused on Democratic legislators who originally voted for it, and then they changed their minds. Now, this was deliberately, this isn't a design. A few other people have used it because, in effect, the representatives become their own control. We use this because I got frankly sick of hearing that you can't prove that legislators did something for money. An individual legislature, because of that little error term, that's probably true. But a group, nah. What we found was pretty straightforward. Surprise. About every time you got $100,000, the odds went way up that you'd vote for to weaken the Dodd-Frank legislation. And some of these folks got really a lot of dough. Now, this is in effect the political money aspect of the rolling back of the Dodd-Frank bill, which has preceded sort of like a series of small seismic shocks for many years. You will be astonished to learn that when the Trump came to power and Trump won, the Fed changed their tune, and they they just kept watering it down. There's a whole host of things here which you can just read. If all kinds of things just didn't happen. And when the Biden administration came in, they tried to do a reset, because especially on the Basel III Accords, like, that was getting kind of embarrassing. And now today, I think nobody would be embarrassed. They would, but at any rate, that didn't happen, and it probably never will. This got us to the position where just after last April 2nd, you had Bank of England regulators. BIS people were telling me it was a former governor of the Bank of England. I have no way of proving that, but somebody did tell the London Times that. You can see this paper that Servas Storm and I wrote on the aftermath of in the Treasury market not too long ago on INET. They were openly saying the U.S. is running a proposed new capital rules. Is running a regulatory race to the bottom, and it's so nice now that UBS is thinking of moving from Switzerland to the United States. Now, how would you like, so have another mega bank, just what you need, right? In case of a bailout, because the Swiss problem is very simple. It's that bank is too big to bail for those folks. So go someplace where they don't seem to really think too much about the total bill. All right, so I'm not, in other words, trying to tell you that everything is wonderful with bank regulation. If you like, King Kong, in other words, has its own problems. But now let's look at Godzilla, which is crypto. And, pretty straightforward. Let's throw out the meme coin discussion, which I think really should be treated as gambling. It's basically, if you put this in the context of the spread of betting all around on just about everything, you get a much better perspective on it. And a lot of this stuff is purely speculative. On the other hand, the stablecoin folks are claiming they've really built a better mousetrap. But this then gets confused, in fact, often deliberately run together with talks about how great technology is, blockchains in particular. Well, actually, empirically existing blockchain is pretty slow. You can't actually put too much stuff on it. People are working hard on that. But we're a long way from making that work. And if they could do it rapidly, you could just as well if they are actually able to do a blockchain as rapidly as the stablecoin people said, just have the central bank run it, give it to everybody. You don't have to put it on a blockchain. You could probably be better off just skip the blockchain business and just do like they do in Brazil. But you know what? The same pattern of legislation that just pushed across genius is having clarity and suspended animation. You see a big vote against central bank digital currencies. Guess what? Neither the banks nor the stablecoin folks like central bank digital currencies. Well, all right. This is where I think the Hispanic finding that we found, I wasn't looking for that. I just ran those out of the usual sense of, okay, we should run the standard variables. I think it's remittances across borders. And when you actually look at what people say about this, they're always bringing up the case of, well, international payments will be so much cheaper there. And, the Coinbase bird that I quote there on this, this is actually, it's a very common claim. Now, first question is whether it's true, and the short answer is it's very hard to tell, but I'm also sure that because in effect you've got clashing financial systems here, what's going to happen is the margins everywhere are going to start endogenizing to this somewhat different oligopolistic competition pattern breakdown. And I think any number, if you listen to the banks a few years ago, they hated the know their customer rules. Now I think they're touting them just a touch. Guess why? Because the know the customer. All right, I don't even have to. I can see everybody's already laughing. The BIS had an estimate. If you listen to the bank some years ago, it was like just this horrible burden. The BIS says no and actually has some numbers, but we'll just move on there. In the back of this, though, is another regulatory problem, right? It's that, it's been a long time since big banks were interested in serving poorer customers. Competition failed here. It fails in credit cards. And that is giving Coinbase and these folks an opening that, if you ask me, they shouldn't have. That's where I go back to what's really on that title. Yeah, I'm a political opponent of crypto. That's the Coinbase guy saying, hey, it's really all about the cash that you're ripping off. Effectively, though, and here's a warning, I think, when you start to study this, what I think you come to this view is that the claims that you are a potentially better technology could be true, could develop. If you think of the various technologies here as a combination of cost and security, and sort of it could turn into something that was maybe useful. But right now, what you've got is probably low cost and low security, to be blunt about it. Just to summarize, it's very important to understand that ransomware criminals really almost always demand payment in crypto. Usually it's Bitcoin. I've talked to corporate execs who've told me how they watch as they pay ransom. The thing goes onto the blockchain, so you can sort of see this thing bouncing around. Then it heads into something like a casino, and then just breaks into a million wallets that people can't identify. Jeff White's book, Rinsed. I never met the author. I'm not trying to, but it's a super book on this question. It's like you really need to sort of come to change with this. And as actually, it was an FT article only about a week or two ago, and I saw they were actually quoting or thanking Dennis. Yeah, all these ATMs, they're overwhelmingly in poor neighborhoods. There's a national and an international side to this. First of all, you can get people to do money laundering for you, handing out, if you can get some kind of a bank card in their hands that's worth a small amount of money. And that's a common form of laundering. You also can do that abroad. Lots of folks have noticed the philanthropy that some stablecoin proponents have done internationally. White's book will give you a sort of new way of looking at that. And in general, the thing to think about this is there's not just the blockchain. The blockchain is full of these intermediaries. Everything from crypto wallets to brokers to other stuff. And if you're going to do an international payment and you don't want it in dollars, then what you're going to have to do is you're going to find a currency dealer. Now, they may own the currency dealer, but you can see all the inventiveness stuff now. Even right now, a huge battle has started because the Genius Act apparently prohibited interest on stablecoins. I just saw last night where one big stablecoin is talking up to 10% as you can make for loaning out your stablecoins. Well, it's not loaned out through them, and you get this kind of a network that often has, there's several good empirical papers on how concentrated many of those networks are. So that in effect, you're putting money in somebody's pocket, and then you're taking it out there. So this leaves us pretty much where the act leaves. When I read the act, I'm not a lawyer. In fact, I'm very much on the Shakespeare side. Henry IV, killed all the lawyers. It's crossed my mind from time to time. But what you actually have here is it looks like a sort of deferred legislative thing. In the implementation stage, where basically the defining character of that stage of implementation is big money's around, nobody's paying attention, and then watch what happens. In the meantime, watch what they do, not what anybody is going to say in a year. They dismissed the Justice Department's National Currency Enforcement Team. The Trump folks got rid of the Corporate Transparency Act, which Janet Yellen had introduced right as she came in as Treasury, saying this was an important thing to control shell companies and actually get for transparency. Now, CISA, this cyber security agency, this is a question that needs much more interest. I know the folks there, or I did, and they spent a lot of time trying to go around to companies and saying things like, you've got to do something about your cybersecurity. And the take-up has been slow. A very important point is an article by I think of Tom Oren, on the lessons of the insurance market for cybersecurity. It's real basic. It's that you can't. Nobody has figured out a way to actually price in the means of real facts about cybersecurity based on the disastrous incidents that happen. So instead, what they do is they charge by size of firm, and pretty much standard firms. That, in other words, this is a warning to you that the private market solution won't work. So Oren says the only thing that works is to just tell them, here are some things you've got to do, and put, in effect, advanced stipulations on that. If you don't do that, you're going to have a huge problem. Look, the era of quantum cryptography is coming. And I mean, I just saw a thing where just yesterday, some kind of 6-bit elliptical cipher was busted by a quantum thing. Now, Bitcoin's got a lot bigger than 6 bits in it, but like this is really happening between AI and quantum. The combination of those and agents, you're looking at a real disaster. And the sort of situation, everything is going to shift. Any number that people quote you about what this stuff costs for a transfer, it'll be different in a year. But the big thing to remember is you got two giant systems of finance. They're now colliding, and political money will be everywhere. Thanks.